What will the coronavirus recovery look like letter-wise? It's the question everyone's asking as the U.S. economy continues to reopen. On today's show, we'll take a closer look at the great debate and why you should pay attention to the answer. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
JeffSmall, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, JeffSmall, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. If you watched our show last week, you saw a rather, let's call it spirited discussion with our guest, Harry Dent, about what's in store for the U.S. economy and the financial markets as the country attempts to return to normal. The debate got lively because it's an important question for which almost everyone seems to have a different answer. Ultimately, the question boils down to what letter shape the recession recovery will take when charted on various economic graphs. Is it a U, or a V recovery, or a W-shaped recovery, or an L-shaped recovery? So the main question is whether it's really possible, given the scope of this crisis, to have a V-shaped recovery, which would mean the economy bounces back fairly quickly with no major setbacks. So far, Wall Street seems to be betting on a V, while some are citing reasons for why a V-shaped recovery is possible. Others are citing reasons why it absolutely isn't. We'll explore all sides of the question on today's show and tell you how to protect and maximize your retirement income regardless of the answer. And joining us, of course, will be former Arkansas governor and a New York Times bestselling author, Mike Huckabee. And also joining us will be my co-host, JeffSmall. But before we bring out Jeff, let's take a closer look at so-called recession shapes and how they occur historically. Letter shapes are really an informal tool used by economists to describe different types of recessions. The most common shapes are the U, the V, and the W, but there's also the dreaded L-shaped recession. The shapes take their names from the approximate letter that forms when economic data is tracked on a graph. In a V-shaped recession, the economy has a steep but short period of decline with a clearly defined low point followed by strong and steady recovery. The recession of 1953 is often cited as perhaps the best example of a classic V-shaped recovery. Growth began to slow in the third quarter of that year, but by the fourth quarter of 1954, it was back on pace and trending upward. Therefore, when charting the up and down data for GDP growth, employment, and stock market performance at that time, you get a clear V-shape. A U-shaped recession is longer than a V-shaped recession and has a less clearly defined bottom point. Growth may shrink for several quarters and only slowly return to its previous upward trend. The 1973 to 75 recession is often considered a good example of a U-shaped recession. The economy began to shrink in early 73 and continued to decline or maintain very low growth for almost 2 years before easing back toward recovery. Now, in a W-shaped recession, the economy declines sharply. It recovers for a short period of growth, then declines again before fully recovering. It's also known as a double dip recession because it creates that distinct up and down W pattern on a graph. The early 1980s recession is often cited as a good example of the W shape. The economy shrank from January to July of 1980, then it began recovering, but then it fell sharply again from July of 81 to November of 82. After that, the U.S. economy and the stock market recovered and went into one of the longest and strongest periods of growth ever in our history. And finally, there's the dreaded L-shaped recession or depression, in which the economy has a severe, widespread downturn and does not return to trendline growth for many, many years. Given the severity of the coronavirus crisis and the ongoing uncertainty around it, why do some analysts believe that a V-shaped recovery is still probable for the economy and financial markets? We'll talk about that more coming up in just a bit. Right now, it's time to welcome my good friend and co-host, JeffSmall, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also the Retirement Income Store's very own brand ambassador and Amazon best-selling author of the book, Turning Financial Planning Right Side Up. So Jeff, talk to us. Is it a V? Is it a W? Is it an L? Is it a U? What the heck is it?
Well, I think short term, we're obviously in a V for recovery on the markets, Dave. I mean, the markets, the animal spirits are alive. People are buying stocks. The yield curve is steepening. The dollar is falling. There's huge pent-up demand in the economy, and this is propelling finally a rotation back into the consumer-based stocks that we thought were going to get hit prior to the onset of the virus, and that did get hit during the virus. And so what do you think is happening right now? Do you feel the same way?
Okay, so stock market, you're right. Hindsight's 2020. So thank you for telling me something I already know, that so far we have a V-shaped recovery. But the question is there going to be another V next to it? In other words, will it be a W-shaped recovery? That's the thing that I'm really wrestling with, because I think there's a good chance that we could have a W-shaped recovery, that the V might not be the end of it when it comes to the stock market.
You know, you're trying to set a trap for me, Dave, because I've been bullish and right the last 3 or 4 shows, and you've been bearish and wrong. So I can see what you're doing. You're luring me in there to see how my long-term approach is going to be on the market, because you know I think it's going to be a W. You want to explain a W?
Okay, so you do think it's going to be a W. Okay, so then we're on the very same page there, which is great, that we've had just about that first recovery, which means now we've got to be cautious moving forward for that second part of that W to form. Got it. But how about the economy? The economy. I mean, I'm pretty much guessing that you're probably not focusing on a V-shaped recovery for the economy, correct?
Well, it's hard to tell, Dave, because we only lost 2 million private sector jobs last month in the recent ADP report, and we were expecting 9 million jobs to be lost. And then last week, we had only 3.89 million people come off of continuing claims and unemployment. So we had a $2 million contraction in total unemployed in that 1 week. So people are coming back to work. So, I mean, we're in uncharted territory here. We had a mandated stop, but I think there's going to be a mandated restart, and people are going to go back to work very quickly as the virus continues to decline on its infection rate.
Mm-hmm. It'll be interesting. One of the things I want to ask our guest, Mike Huckabee, coming up in just a little bit, is I want to find out his thoughts on, you know, what next steps he thinks Congress might take, or the government might take, or the Fed might take, for that matter, in order in helping a second round in case there's a second round of infections. Because you've been pretty vocal that there has to be an uptick in infections. We don't know how much it's going to be, but because people are getting back to work, they are getting back to doing some of those things, going to restaurants and so on, there has to be an uptick. So it'll be interesting to see what his feedback is with that, in terms of, you know, because part of determining the shape recovery for the economy, and certainly for the stock market, has to do with what Congress or the Fed is prepared to do in addition to what they've already done. I mean, is it not?
Well, Congress is trying to do more, but it's a 4-letter word. It's called pork. And so they're not really helping people that are affected by the stimulus. They're funding all of their pet projects. And that's why there's $3 trillion stimulus bill stuck in the House, because it has no chance of passing the Senate. So, you know, that's the problem with Congress right now. Congress isn't doing the right thing, and that shouldn't surprise anybody. Yeah,
well, it's always gridlock for sure. So it's okay. So the economy, if I had to push you, is it more V-shaped recovery or U-shaped on the economy? If you had to pick one, which would you pick if you're sitting here right here today?
Without a second surge in the virus, which is going to be really hard to believe that it doesn't occur, especially with the mass gatherings we've had this week, it's going to be impossible for there not to be a second surge. I'm looking 30 days down the road, Dave, and we could be talking about a different topic here about what's happening with COVID-19 and how it's exploded. And so I think we're in a very tentative place right now. I don't know how to answer that question, to be honest with you. Based on evidence-based science, it says yes, it will happen.
So you're thinking, if we don't get a second wave and science is wrong, and I tend to agree with you on the science part, by the way, then you say, well, it could be V-shaped even for the economy itself. But you're saying, when you get a second wave, then it might be more U-shaped. Without putting words in your mouth, is that kind of what I'm reading between the lines on?
I would concur. I would agree with you on that. We are one on that.
Yeah, and I got to tell you, I believe it's the economy is going to be U-shaped. So the reason I think we're looking at a W on the stock market is the economy has to be U-shaped in terms of recovery, because even if things come back, you know, if we're down on our economic output, you know, our GDP economic output at the end of last year was 21.5 trillion, I believe. And all the forecasts are saying by the end of the second quarter, our annualized output's going to be 12 trillion, maybe. It's going to be almost cut in half. So even if 3/4 of that recovers, and we end up going from a 12 trillion down back up to 18 or 19, we're still talking cumulative GDP shrinkage for the year of 10%. And I just don't think that every sector is going to come back 100% economically by the end of 2020. So that's why I would say I'm looking at U-shaped on the economy no matter what. And I'm afraid that as all the Wall Street cheerleaders finally come to fruition and figure this out, that's when we'll see that second leg down, the second part of the W on the stock market.
Well, the day that news hits, Dave, the market certainly isn't going to go up. But for our listeners and our viewers, they've got to prepare for that and not be complacent, because right now there's a new realm of complacency coming into investors that are holding equities, and they have no idea what's coming down the pike, and we've got to let them know.
Yeah. Yeah, and you have to be cautious. The thing here is, if you're a day trader, you could have made a lot of money over the last few weeks even. But the reality is, most of our viewers, most of our listeners, income generation members, are too close to retirement. And they don't want to speculate on where they think the markets and the economy is going to be a year from now. It's just too risky for them. And as a result, that's one of the reasons that I've been so bearish, I believe, is because even though you were right in terms of what happened over the last month in the markets coming up with that V-shaped recovery, it doesn't mean that I want to play that game. Sometimes you have to make that decision. If the game's too dangerous, do I even want to play it? So we need to take a quick break here. So when we come back in just a minute, Jeff, as you know, we're going to get a great chance to talk to Mike Huckabee. So you'll want to stay with us also. We have a lot more fun stuff coming up here on the income generation in just a moment. We'll be right back. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved. It's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
The U.S. economy will come roaring back to life and is already in the process of doing so. And that is according to one Wall Street strategist. He's also not alone in that opinion. Recently, Michael Wilson of Morgan Stanley wrote that he believes the U.S. economy will have a V-shaped recovery for two specific reasons. First, due to the historic steepness of the decline in economic activity, and second, because of the unprecedented policy response. Now, if you watched our show last week, you know we talked in great detail about the Fed's response, which has indeed been unprecedented. So far, it includes open-ended quantitative easing and the creation of new lending facilities to help maintain the flow of credit to businesses, large and small, as well as to households and municipalities. In addition, Congress has responded with the largest economic relief package in U.S. history, totaling $3 trillion in aid so far, including stimulus checks sent directly to taxpayers. Now, some argue this intervention may help ensure a V-shaped recovery. This is combined with the nature of the crisis and the strength of the economy before the pandemic hit. Some even say the case for a V is obvious. As states continue to ease restrictions, restaurants that were closed will reopen, along with salons, casinos, retail stores, and other so-called non-essential businesses. The millions of people who worked from home during the crisis will go back to their offices, and many of them will have built up savings during the quarantine that they're anxious to spend. According to one study in March, the personal savings rate for American workers was already at its highest level in 3 years. Even those who lost their jobs during the pandemic are protected by a weekly unemployment enhancement check from the government until they find new jobs. Moreover, V-shaped advocates argue there's no sustained damage to the economy from the shutdown. Of course, different from the Great Recession, where the entire financial system buckled, major lending institutions went bankrupt, and the housing market collapsed. Some are arguing that once we get past some undeniably ugly second quarter GDP numbers, the economy will be like a rubber ball that hits the floor and bounces right back up again. If you're following the stock market, you know it looks like big investors are banking on that bounce. But what about everyday investors and other economists? Why are many skeptical about this possibility of a V-shaped recovery? We'll talk about that more coming up in just a bit. And that's where we want to bring in our special guest, former Arkansas Governor Mike Huckabee. Governor Huckabee is the host of the TV show Huckabee that airs on TBN each and every weekend. He's also a Fox News contributor and a New York Times best-selling author of 14 books. Governor Huckabee, welcome to the Income Generation. It's great to have you on the show.
David, it's a pleasure to be here. Thank you for having me. Look forward to our conversation.
So, just take me back to the days where you were governor. If you were in the situation as governor, would you be feeling as though you're given enough control, enough latitude by the federal government? Or on the other side of it, do you feel like you're given enough direction from the federal government as a governor of Arkansas?
You know, in the nearly 11 years I was governor, I never felt like I needed more direction from the federal government. What I needed was more flexibility. What I needed was the opportunity to do the job that I was elected to do. I think the president has handled this right. He has recognized the 10th Amendment of the Constitution. He has allowed the governors to make the decisions best for the populations of their states. That's how it's supposed to work, because Massachusetts and Mississippi are very different. New Mexico and New York, very different. And so how decisions are made in each of these locations should be made for the benefit of those closest to those being governed by those who are closest to those being governed.
Okay. So if we happen to have any President Trump haters that happen to sneak on Newsmax to catch just a minute of the show, which I doubt, but if they're there, I have to tell you, you just heard it right there, from Governor Huckabee. All the cynics like to say it's his way of passing the buck and having plausible deniability, but I agree with you. He's really doing the right thing, because every state is different. So, how about improvements? You know, it's funny because if you think back 4 years, you could be sitting in the White House right now. Right, there was a time in 2016 where nobody knew what was going to happen, and as a result, you must have some things that you would do slightly differently if you were president of the United States. What are some of those things?
Well, how easy it is for me to sit here now and tell you
Right.
how I might have handled certain things differently. Again, I want to say I commend the president. His action in late January to suspend travel from the Wuhan area of China was incredibly important and instrumental in saving countless thousands of American lives. He's never been given credit for that, certainly not by the Democrats, nor by the media. But then again, I repeat myself because they're one and the same these days. But that decision was important. Secondly, this is a president who surrounded himself with some of the top scientific minds, people who understand infectious diseases, the CDC, Dr. Fauci, Dr. Birx, all of these people that he surrounded himself with, and he took their advice. So for all the people whining that he doesn't pay attention to the science, I would suggest they're the ones not paying attention to the science. Now, in retrospect, should we have shut everything down to the degree that we did? Perhaps so, because it did flatten the curve, it did stem the tide. We did not have a rush on our healthcare system where so many people couldn't get in. But I think we're going to look back and see that there were certain governors and mayors who went too far. For example, they said, you can go to the liquor store, but you can't go to church. You can't go on the beach and be out in the sunshine, which sunshine kills coronavirus, but we'll take you off the beach and take you down to Walmart. You can rub shoulders with hundreds of perfect strangers in close quarters. So there were a lot of things that were done that were irrational, illogical, and I think the voters ought to punish those politicians who did some things to them that simply made no sense. A good example is in Michigan, where you had a governor that said that you could go to the hardware store and you could buy things off the shelf, but certain things you couldn't. You could buy, for example, some garden implements, but you couldn't buy seed. I mean, that kind of stuff is beyond ridiculous. So if there's any criticism I have of the president, and I think that's kind of what you alluded to, there may have been a little bit too much of a positive, everything's going to be okay, we've got this all under control at the beginning. I know the president very well. I understand where he's coming from. He's trying to rally people, give people hope, and not to scare them. That's a good thing. But I do think that in the early days, when he basically said, this isn't going to be a big deal, we're going to be fine, we can test everybody, we can handle it, we might not be quite there in those early days, and that may be the one thing that I would have advised him to be cautious.
And 30 seconds left in this segment, but it sounds like the other thing, and that's a good point, thank you for that, but it sounds like the other thing is also that you might have given the states just a little bit more guidance from the experts, just so that some of these states didn't go as far off in left field as they did. Without putting words in your mouth, is that what I'm hearing?
Pretty much so, although I think that you elect people to make decisions, so we shouldn't have the federal government dictating to the states. Sure. He did what he should have done, give them the guidelines, which they did, but some of them took it and they went a bridge too far. That's on them, not on the federal government or on the president.
True. Good point. Like you said, the Constitution. Governor Huckabee, don't go away. We need to take a commercial break. And you stay with us, too. We have a lot more coming up right here on the Income Generation in just a moment. We'll be right back. Hi, I'm David Scranton. As we reopen America during these difficult times, we're all practicing social distancing. But at the Retirement Income Store, we're also practicing stock market distancing. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
A V-shaped recovery is off the table. At least that's the opinion of the Federal Reserve's Neel Kashkari. At a recent roundtable discussion, he predicted the recovery will likely be long and drawn out, and that by the end of the year, the economy will be nowhere near where it was in December of 19. Although the stock market had recovered roughly 3/4 of its losses by the end of April, Kashkari said he doesn't believe equity prices are an accurate indication of the true health of the economy, and that, quote, stock pickers are just wildly guessing, close quote. Now, if that sounds familiar, you may recall that on last week's show, we talked about the disconnect between the stock market and the economy during this crisis and the reasons behind it. It's not a new issue, but like so many things, it has been amplified by the pandemic. Many other economists concur that a V-shaped recovery is off the table, citing a long list of reasons. They agree the economy may bounce back, some by the end of the year. However, it certainly won't be enough to make up for the 30 to 40% GDP decline that even the Congressional Budget Office is now predicting for the second quarter. Even as states continue to lift restrictions, most analysts doubt that customers will flood back into stores, flood back into restaurants, car dealerships to the same extent they did before the crisis. Airlines and hotels will take a long time to return to normal. Even worse, companies that were barely hanging on before the pandemic, like JCPenney, Neiman Marcus, and several others, will fully collapse. According to the Financial Times, only 1 in 10 global fund managers are actually anticipating a V-shaped recovery. Other analysts point out that the pandemic has worsened economic problems that already existed before the crisis. These included issues like the decline in U.S. manufacturing, the trade war with China, the fact that personal credit card debt was back to an all-time high for Americans. And while all of this helps explain why many analysts reject the possibility of a V-shaped recovery, the question of just what shape the recovery will take remains highly debated. Some say a U is more likely, some say a W is more likely. Others have proposed this recovery might closely resemble the Nike swoosh. Some even say we might be in for an L-shaped recession, in which there isn't really a recovery for a very long time. Now it's time to bring back our special guest, former Arkansas Governor Mike Huckabee, host of the television show in his name, Huckabee, that airs on TBN, also a New York Times best-selling author of 14 books. Governor, thanks for sticking around.
You bet, David. Glad to be back.
So I was actually at an event over Memorial Weekend with some family, and we're all social distancing and being careful. But you know, they started to talk a little bit about some people whom they know that really are reluctant to go back to work. Even if they can, they don't want to go back to work because they're actually making more money now being out of work than if they had gone back. And I know you've been a little bit vocal about this. So tell our viewers your thoughts about this and what you would do if you were president to try to, what do you think our government should be doing to try to fix this, and what employers could do to make this better?
Well, David, I think people need to realize that Congress has to go back and tweak this assistance package. It was necessary to help people through the shutdown because they didn't lose their jobs because of anything they did. They lost it because the government decided to shut everybody down. So I realize that that was important. But the flaw in the legislation was that it did not create a connection between what they were earning and what they would be paid in unemployment. No one should make more money not working than they made when they worked. If you want to get equal to it during the period at which their employment is not existing, that's one thing. But when you pay people more money to not work than you paid them to work, people are going to say, hey, I like this not working. It's working out real well. So Congress needs to tweak that. And people, when offered their jobs back, they need to go back to work. And if they don't, the unemployment benefits need to stop immediately. Simple as that.
So you talk about congressmen and congresswomen, and of course those are a subset of the politicians who you said if a politician orders a shutdown, they should not get paid. They should not get paid during that time of shutdown. They should waive their checks. I think I know, but tell us what the logic is behind that.
Well, if you're making a decision for other people to lose jobs, I think you should say, look, we're all, you hear this phrase, we're all in this together? No, we're not. None of the politicians quit getting paid. None of them. Not one. Mm-hmm. None of the health experts who trotted up to the microphones and told us how that we can't go back to work until maybe the fall and we need to close everything from every theater and restaurant in the whole world. None of them quit taking a job. But all the people working in those restaurants and all the people who own those restaurants and are trying to figure out how to pay the fixed rent cost on them, they all lost their jobs. So here's my point. When we really are in this together, everybody shares some pain. I mean, I lost a third of my income because all my events got canceled. A radio station that I owned basically was busted because nobody's buying advertising because nobody's open. So here's my point. If all of us are really suffering, and you tell me we're all in this together, then get out in a boat with me. Give up your paycheck. Take maybe a minimal government salary. And I'd say to members of Congress, since you're not showing up, you shouldn't get paid at all. Mm-hmm. I guarantee you, David, if we started saying that the people who make the decisions to shut things down don't get paid until those people shut down get paid, you'll see some very different decisions being made.
Sure. Now, changing gears for a second, what do you think about what additionally can we be doing to help some of those small business owners that are really, really struggling?
I think the biggest single thing is to let people get safely back to work. And that means that trust people. We're Americans. We're freedom-loving people, and we're not stupid. If you tell us that we need to be careful about touching doorknobs and touching things, sanitize our hands, okay. But there's no reason that you shouldn't let small boutique shops open and let the big box stores open. You're far more likely to be infected from the virus by being in a crowded big box store than you would be going to a small boutique where maybe one or two people are working and maybe 2 or 3 people are shopping at any given time. Trust that people can make good decisions. As a business owner, it's in their best interest to take care of their customers. Will there be some people who violate it? There always are. Some people speed, drive past the speed limits. They do a lot of things they shouldn't do. You can't fix everybody, but you got to restore freedom to this country.
Well, I guess just like you have to be careful for the fool that's going through a red light when you're driving, even if you have a green light, you also have to be careful in a store or other business when you see somebody not social distancing, not wearing a mask, and be careful of them, just like that person going through the red light. So 30 seconds. We had Dr. Ben Carson on the show just a couple weeks ago, and he joked that every once in a while the president would look at him and say, "Hey Ben, aren't you glad you didn't get the job?" Have you ever thought about that yourself, or do you feel like I'd love to have the opportunity to show the leadership and to have done some of the same things the president's done?
Well, I mean, I think every person who runs for president really wants to be able to do the job. But by the same token, I'm very pleased with how the president has handled things. And quite frankly, we needed somebody who is unafraid to fight any and everybody in his path to get things done for the country. He's done that. He's done some things sometimes awkwardly, not always artfully, but I'm grateful for the things that he has gotten done in deregulation, cutting taxes, stopping the unfair trade wars with China, renegotiating NAFTA. I mean, there have been a lot of things that this president has done for the economy that have transformed it. And thank goodness we went into this pandemic from a point of strength, not a point of weakness.
It's interesting. Dr. Carson said the same thing. He actually said, the fact that the president's not afraid to be confrontational is great at times like this. He says, and frankly, I couldn't have been that person. That's not my personality. So we appreciated his honesty, and we really appreciate your time today too, Governor. Thanks so much for joining us.
David, it's been my pleasure. Thank you so very much.
And you stay with us too. We have much more to come right here on The Income Generation. We'll be right back.
All right, that's a wrap.
All right, very well. Thank you. Thank you. Now let's welcome back my co-host, JeffSmall. So Jeff, you are the brand ambassador for the Retirement Income Store. Why didn't you tell me that we could save all this money by getting a discount by advertising on Mike Huckabee's radio station? Why didn't you tell me that? What's wrong with you?
That's not my job, Dave. I've got other things to do. That's your technical and marketing people. I mean, Sarah's in there and a few other people that should be taking care of that. Sorry, Sarah.
It's funny. He did say some. I like what Mike Huckabee said. He said that he's good that the states had flexibility to handle it however they wanted. I think it's good that he also said that a little more guidance would have been good. But look at what's happening now with this whole incident with poor Mr. Floyd. I mean, what obviously happened to him was a travesty. In any industry, even in our industry, there are a few bad apples. In the police, same thing. I mean, so most of the cops in the world themselves probably cringe when they watch that video and they see what happens. But that's an example of where Trump is trying to give the states more guidance. And look at all the blowback he's getting from that at this point. I mean, I don't know about you. You probably grew up the way I did. My mama taught me from the very beginning, 2 wrongs don't make a right. So even though a travesty occurred, burning down buildings and breaking in and looting doesn't fix the problem. It doesn't make it any better. And I think that's the message he's trying to send to the states, but he's getting pushback from a lot of the states, especially a lot of the blue states.
Well, I think that there's a constitutional issue there. He can only do so much as president without he can't really supersede the states. But I think, the other problem that I have is there's no doubt that was the most horrific video that any of us have ever witnessed. And pray for the family, pray for the man's soul, pray for the people that caused this situation. So the problem is, Dave, that I have with all of these states is they have allowed people to protest and mass gatherings, but a week or 2 ago, they were arresting them for going to the beach or going to a public park. And this is a massive contradictory. So I don't, I have to question what are the real motives here politically, and I'm not, I'm in the middle here. I'm going to be independent on this one, but I have to question what's happening. It doesn't make any sense.
I will tell you, and I'm not a conspiracy theorist, at least I don't see myself as being that way, but I actually have a good friend that just told me yesterday that he thinks a lot of this stuff is somehow secretively getting funded. It's so organized that a lot of these riots are getting funded by liberals. He actually said that this seems like some of these places where these riots are occurring, there are huge pallets of bricks getting delivered as people are starting to gather. And I mean, I can't even believe that's true. I mean, he's a pretty credible resource, but
No, it's true. I've seen the videos, and in a lot of these cities, people have been forming vigilante groups and walking around with guns just to protect their properties, their house, their businesses, whatever. And it's really a sad state of affairs. That's what it's come to. Protest, no doubt protest. But don't victimize other people. And we've seen several people pass away and be killed as a result of these protests. That's not necessary, Dave. It shouldn't be happening.
No, I agree. And I wish you and I could do something to make it better. Unfortunately, we can't. But what we can do is at least help to the best extent protect our listeners and our viewers from the markets, from the economy, and everything that's going on. So let's get back to this L-shaped, V-shaped thing, U-shaped. So we disagree with part of it. We agree with part of it. But do you really think that's appropriate for most members of the income generation to gamble on something? Even though in hindsight you were right. So far the stock market looks like a V-shaped recovery. We're almost back to the peak. Is it really proper for them to gamble on this without the fundamental support at this particular time?
For retirees that are over 55 or 60, that for our listeners and our viewers, you're going to have to expect a massive pullback at some point in the market. Again, the market's just come back too quickly. The worst thing that you could be doing right now is have an era of complacency and satisfaction, knowing the market has come back already. This is the time to get out and de-risk, because you can't replace the assets when you're retired. You're not working, and you don't want to play the catch-up game. Nobody wants to play the catch-up game, Dave.
Yeah. So, you and I are part of the income generation, right? And we're at a point, or at least very, very close to, actually, we are part of the income generation. And for us, we know what was long-term is starting to get shorter and shorter as we get older, right? Is it not?
It really is. And people have to understand also, Dave, that the next 10 years of stock market growth is going to be nothing like the last 10 years. And so you want to find a professional in the financial realm that you can work with who understands that's not, as Dave would call, a Wall Street cheerleader and always says be in the markets.
Yeah. And in the last 10 years, the total return on the market was only 5.8%. I'm sorry, last 20 years, since the turn of the century through the end of 19, 5.8% average annualized return, and that's it. So even that wasn't so great. Stay with us. We're coming back in just a moment, right here with more. JeffSmall and David Scranton on the Income Generation. We'll be right back. Welcome back to the Income Generation. I'm David Scranton. I'm here with my good friend and co-host, JeffSmall. Now, just this past week, there was an article that came out from The Economist magazine that said there was a, quote, dangerous gap between the markets in the economy. And Jeff, I know you read that article. I know that dangerous gap, is part of the reason too why we're talking about another leg down in the stock market. But I guess my question for you is, is that gap ever going to go away? It seems like we've been struggling with this since the financial crisis, this gap between, because all the quantitative easing and so on, the gap between the economy and the stock market. How does it ever rectify itself, or does it?
Well, I think the economy is real and the market is unrealistic at this point because there's such divergence, like the article had said. But once the real information on the economy starts to get reported and the market realizes that the economy isn't growing and probably not going to grow over the next 12 months, we're going to be below zero, negative growth. Once it realizes that, I think that'll finally start to bring some reality back into the markets, Dave.
Interesting. Well, that'd be a good question for next week's guest. Next week, as you know, we're having Mohammed Al-Arian here on the show. And Jeff, you have a better memory than me, so I'm going to ask you to please remind me next week to ask this question to our good friend Mohammed Al-Arian. Fair enough? Can I count on you to do that?
Well, you can count on me to do that, but Dave, to be honest with you, since I've been right over the last month or so about the markets and you've been wrong, maybe Mohammed can finally settle the tiebreaker between us.
Okay. All right. I guess I can go along with that. I know Jeff's a lot smarter than you and maybe a little smarter than me, so maybe he'll have the proper answer there. So I'm just kidding. When in doubt, ask somebody smarter than both of us, right? So I think we're on. But that's another thing you have to remind me to do next week, Jeff. Fair enough?
Yeah, no doubt, Dave. But Mohammed is brilliant. I can't wait to hear his perspectives, and we'll see where he leans, towards me or towards you.
Yeah, we'd like to have him on the show every couple of months or so for our viewers, our listeners. It's good to have him on because he's a visionary. He's the kind of person who's a thought leader, who's always helping you think ahead as to what could be happening in the future so you can make good, informed decisions, which, of course, is always what this show is about, giving you the information necessary so you can make the proper decisions what to do with your money and showing you both sides of the argument, right? Today, for example, you got to see my side, you got to see Jeff's side, you got to see the difference. Because Jeff, I know, is a financial educator, right? If you're showing somebody one side, your opinion, then how's that person ever going to make informed decisions when it comes to their money?
They're not going to. I mean, education is the key. Knowledge is power. They've got to learn. Mohammed is one of the best prognosticators in the business. Everybody wants to tap into his genius. It's definitely a show you don't want to miss.
All right. Well, one more week from now, we'll have Mohammed Al-Arian here as a guest. We'll have some fun. So stay with us. We have more coming up in just a moment on the income generation. We'll be right back. I'd like to thank former Governor Mike Huckabee and also our co-host JeffSmall for joining us today here on The Income Generation. And most importantly, I'd like to thank you, our new and returning viewers. Analyzing the financial markets is a complicated process. That's true in the best of times, but more so than ever in the midst of a crisis, particularly one that in many ways is unprecedented. There's a lot of math and complex calculations involved. Analysts evaluate cash flows and how they relate to lump sum values and discount rates, etc. Some traders even use algorithms and textbook formulas to make predictions and to advise clients. It all sounds very impressive, and some of it is. Today, though, many brokers, many advisors, and media pundits are arguing that a V-shaped recovery is possible, and using these same kinds of impressive formulas and calculations support their claims. However, I encourage you to keep a few things in mind. These same pundits were the ones often arguing in early 2000 that the economy and the stock market was strong because PE ratios of 50 and above were the, quote, new norm. Their calculations and formulas said so, but they were wrong. In 2007, some of these same pundits said the securitization of mortgage-backed securities was a great thing, and credit default swaps were protecting companies. There was no longer a need to worry about this upcoming subprime mortgage crisis that we saw brewing early in 2007. Their calculations and formulas said so, but again, they were wrong. Here's the point. Economic and market analysis isn't just about math and numbers. It's also about people. It's about how they react emotionally and plain old-fashioned common sense. With those things factored in alongside things like unemployment numbers, GDP shrinkage, interest rates, price-to-earnings ratios, a rapid V-shaped recovery from the coronavirus simply doesn't make sense to me. Sooner or later, I believe Wall Street and all the stock market cheerleaders will have to accept this and reflect reality once again. Don't wait until then to take action. Help protect your own portfolio now by making the switch to financial strategies geared specifically toward asset allocation and retirement income, regardless of market conditions. As always, stay safe. And thanks for watching. If you're close to retirement and you really want to know how to help protect and maximize your money, it's essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.